From changing our spending behavior to democratizing access to assets and upgrading how we distribute value in our economies, the $100 billion fintech industry is expected to leave major footprints in the next 5 to 10 years. Access and declining cost of digital technologies and tendencies towards open banking and consumer maturity have initiated accelerating progress for fintech.
However, there are still major challenges regarding regulation and market access. But existing progress and soon-to-be breakthroughs will change the banking landscape in 2021. Let us discuss what these breakthroughs are and what the future of finance is going to look like.
Welcome to the UTX podcast, your source of emerging technologies presented by two Techniax. I am Valentin.
And I am Ani. And today we're going to talk about fintech. We will look at what fintech is, which market players are at the helm of this revolution, what the challenges are, and finally, what a utopian day in the life will look like. And before we dive into it, we would like to let you know that you can find our podcasts on YouTube, Spotify, Apple Podcasts, Google Podcasts, Stitcher, and now also on Medium, where we have turned our episodes into blog posts. The links can be found in the description. Let's dive into it.
So let's talk about what fintech is, the big disruptor of the financial industry. It obviously stands for financial technology, and it seeks to disrupt the whole industry, but especially personal finance. They do this by not only gaining market share from banks and traditional service providers, by providing existing services, but also by making bank internal processes cheaper, faster, and more convenient.
Services that are disrupted by fintechs include investments and their advisory, insurance, trading, risk management, and even traditional banking services such as payments, accounting, escrow and credit markets, and credit scoring.
To draw that a bit further, the main fintech areas are mobile banking, online and cross-border payments, cryptocurrencies and smart contracts, electronic trading and investment platforms, financial inclusion, robotic advisory and chatbots, fraud detection, peer-to-peer lending, AI-based trading, and insurtech.
The rise of digital technologies and increased availability of consumer financial data has enabled and aided the rise of these fintechs.
They make use of the internet, data, and the digital technologies that we know so well, such as secured cloud storage, distributed ledger technology or blockchain, big data and AI, and RPA for robotic process automation.
Open banking and progressing regulations that require banks to share customer data with third-party providers via APIs, such as the EU's Payment Service Directive, have helped to reduce one of the major barriers for fintechs to enter the financial markets: access to the customer.
In general, data regulations like PSD2 and GDPR increase the user's awareness and ownership of their data, as they require the user's consent to exchange and process their data. This is good news for fintech providers, because it raises users' awareness and interest in well-made data-driven products.
Let's take a look at the current state of the fintech industry. The global fintech market is valued at around $120 billion. This was back in 2018, and by 2025, it is expected to grow to $305 billion. So far, this is one of the biggest markets that we have looked at in our episodes, which is not surprising given the size and importance of the financial industry.
The big major fintech hubs in the world are, for Europe, it's London, where you have up to 40% of the workforce in the London Central Business District employed in the financial sector, and London also being the most funded fintech city in Europe. And then you have the Silicon Valley, you have New York and Singapore as classic financial centers.
So who are the big players and what are the various applications of fintechs? As we'll see, the there is a variety of applications and use cases that can be summed up in fintech. And we want to just provide a small sample that represents the variety of use cases that fintech has. So let's look at some of the biggest fintech companies in retail banking, and we've sorted these by market size. And you'll find that it's the payment providers that dominate this list.
And based on this, our first example is extraordinary by all means. It's the Ant Group, the Chinese fintech empire founded by Jack Ma, which is part of Alibaba Group. To our knowledge, they wanted or they aimed to do the biggest initial offering in history, but then didn't. They are owning the large payment provider Alipay, which might be also known to most of us, which serves over 1 billion users and 80 million merchants in China. And also operates a large money market fund, a mutual fund that invests in short-term debt securities, and a credit rating platform.
Next on the list is Stripe, which is a payment processing service with a market valuation of $36 billion. And it is backed by Peter Thiel, one of the early investors in Facebook, and the Sequoia Capital. It is a market leader in providing software to e-commerce websites and mobile applications that handle payments for their customers.
Europe's largest fintech company is Adyen, or I hope that's correct. It's a Dutch B2B payment service provider. So they provide payment services to merchants for on and offline merchants with a market cap of $22 billion US. Through machine learning, the company allows merchants to optimize revenue streams and also detect fraudulent payments.
The largest cryptocurrency company is also on this list, and it is Coinbase. I think many people have heard of it, being the go-to trading platform for cryptocurrencies. They currently have a valuation of $8 billion. In 2017, they reported $1 billion in revenues. They had over 1,100 employees and 13 million users. And we find out that last Thursday, Coinbase revealed their plans to go public via a direct listing.
The next one is also part of popular culture. It's the most popular online discount broker, especially among younger generations, and has had a huge impact on the financial markets, especially the stock markets. It's Robinhood. And it represents a new hype for participation in those markets and a new type of business model for financial market brokers. Trading at Robinhood is commission-free, and Robinhood makes money by directing order flow to specialized parties or faster routes, and by lending margin to traders. Subscriptions to specialized trading tools and information, as well as typical bank business, such as earning interest on uninvested cash or charging fees on debit cards provided to users. Robinhood's valuation stands at $11.2 billion US.
Next on the list, and as a very good example for the impact of open banking, is a Swiss fintech company, Numbers. They have developed an app that allows users to manage all their bank accounts, crypto wallets, and loyalty cards all in one place. They've even introduced an AI feature called Neo, which takes in users' transaction and helps them optimize their personal finances by analyzing spending, uncovering hidden fees, and much more.
One example that we need to mention is Chime, which is a so-called neobank. And neobanks refer to the digital equivalent to a physical bank, a bank that operates exclusively online without any physical bank branches. Chime does not charge any maintenance or account fees. Chime's revenues derive from charging merchants for processing card transactions. At a valuation of $5.8 billion US, Chime has close to 10 million users.
The next company on our list is Green Sky, and they're a very good example of successful cooperation between traditional banks and a fintech. This Atlanta-based loan provider partners with merchants and banks to provide credit programs to consumers as they plan to purchase bigger items such as furniture or other home improvement products with a Green Sky partner merchant.
Regarding the debt markets, we have Credit Karma. It offers a multitude of services to consumers, and most of them for free. These include checking one's credit score and recommendations to improve that score, comparing credit cards and loan products such as car loans or mortgages as savings account and also a tax filing preparation tool.
The next on our list is a company that is very well known in Europe, and it is TransferWise. They are a payment service provider, and they offer cross-border payments between consumers at much cheaper commissions than traditional banks. They currently support more than 750 currency pairs and are backed by Peter Thiel, Richard Branson, and Andreessen Horowitz.
Let's have an InsurTech example, which in this case is Root Insurance, a car insurance company that offers what you could consider smart insurance premiums, because the premium is adjusted based on consumers' driving behavior tracked by their smartphone app. The incentive to reduce risk makes the premium cheaper, road safer, and Root even provides discounts to Tesla owners when they let the autopilot take over the car.
Another company is the Berlin-based Moonfair, which is an interesting example because they democratize access to so-called alternative investments, which mainly are only used by private equity and venture capital, which mainly include private equity and venture capital investments. Now, previously, the hurdles to retail investors were the large ticket sizes and the missing access to opportunity. Moonfair solves this by creating an onboarding process that takes less than 15 minutes and in some cases has downsized the investment minimums by a factor of 100.
Now, Stash is a prime personal finance app that allows users to invest in thousands of companies with as little as $5 using fractional shares. Stash lets you create automatic investment portfolios, optimize your investments for tax advantages. Stash also uses a digital coach and gamification for users to create and monitor goals and learn about personal finance. Stash stands at $2 billion in valuation and has $2 billion in assets under management and 5 million users.
Our last example is Prosper, and they are the prime peer-to-peer lending marketplace in the United States with over $7 billion of funded loans so far. The company is based out of San Francisco and they operate prosper.com, a website where consumers can either invest in personal loans or borrow money for tickets of a couple $1,000s. Lenders can choose to invest in borrowers based on their credit scores and Prosper loan history and ratings, but Prosper also collects interest payments and routes them back to the lenders. And thus they generate money. They also generate money by collecting a one-time fee on funded loans.
It's not a big surprise that all of the examples that we've presented you so far are from personal finance and retail banking. Because when it comes to private banking and corporate banking, the game is played a bit differently. We see that, however, these use cases are targeting many areas of life and definitely all areas of personal finance. We can also see that there are really big players around already and that the retail banking space will shift a lot in upcoming years, leaving little to no space for traditional banks that don't wish to adapt at all. In private and corporate banking, things look a little different. Advising wealthy individuals on their finances and corporations on issuing, buying, and selling securities and business parts are more complex and especially relationship and trust-heavy businesses. Obviously, digitization and new innovations also come into play there, but disruptions happen slower and the strength of these technologies is less obvious than in retail banking.
In Switzerland, the private banking app Alpian made an early try in 2021, having raised $12 million in a Series A round. If they or fellow pioneers become successful, it would open a massive market for fintechs. However, it might prove difficult to attract wealthy individuals away from private banks with robo-advisory, concierge services, and tax optimization. In the new generations and the haves of tomorrow, however, things might look different.
In corporate banking, we need to talk about tokenization. And tokenization challenges the classical ways to issue shares and units of ownership in general. Also, tokenization allows to democratize access to expensive assets. such as rare metals like gold, by creating a digital representation of them, which can be traded in smaller fractions. With pioneers setting up secure digital infrastructure to issue, hold, and trade tokens as small fractional units of ownership in place, regulatory barriers have so far prevented the creation of digital asset exchanges. In Switzerland, however, the Swiss Stock Exchange 6 is expected to launch their digital exchange in the second quarter of this year. Another Swiss player, SmartValor, is also working on an asset exchange for so-called non-fungible tokens, which are unique pieces, each different than the other. An early example of non-fungible tokens on a public blockchain were the popular CryptoKitties, a game that runs atop the programmable Ethereum ledger.
And indeed, this tokenization has touched many different areas where finance and all day-to-day lives meet. So there's definitely a lot that is going to happen in the coming months and years. But with digital assets arising, an ecosystem of service providers around it will arise as well. So with the rise of fintechs, you will also see a rise in providers of custodial services, investment advisory, and asset management for these digital assets and tokens.
Why is all of this so exciting and so disruptive? For personal finance, fintech now offers low to no fees, as we've seen that many of these services are completely free. Also, you have better control and higher convenience of your personal finances by managing them in aggregation in different accounts that you can pull together in one application. You have a better overview and of your spending, and you can use AI to drive analysis of your spending habits.
Fintech also allows for faster and more convenient access to loans, equities, and the stock market.
Fintech is also leading to the democratization of access to alternative investments like private equity or venture capital that previously only institutional investors could benefit from. Also, rare metals fall into that category. The fintechs achieve that by decreasing requirements regarding ticket size, expertise, and time investment.
Fintech has in general also raised awareness of personal finance and financial literacy in societies in general.
For small businesses, there are also benefits. Fintechs offer merchants, e-commerce businesses, and mobile app providers access to cheap, convenient, and safe payment infrastructure, plus data-based optimization of risk and fraud detection, as well as revenue generation opportunities.
Fintechs also create more efficient insurance pooling by allowing safe drivers to take away a value premium, just like root insurance does, and by creating incentives to behave in a way that benefits all of society. For instance, by incentivizing drivers to drive safely. In general, this move towards a value-based economy is very interesting.
For existing large businesses and different new types of businesses, in the corporate finance space, tokenization allows for upcoming new abilities to secure financing a new business model by changing the way that ownership of digital assets and exchange of them is being executed.
And finally, fintech also makes cross-border payments much more cheaper, faster, and much more convenient.
Now you might ask yourself, and we definitely were asking ourselves that as well, why is all of this not happening much faster now that fintechs provide so much value to the marketplace, and now that there is so much leverage with a lot of these examples having a huge track record as well as being part of popular culture. Now, there are a lot of challenges related to this, and we're going to go through the most important ones. First of all, adhering to financial regulations and regulators is a challenging, tedious, and costly process. Smallest leaks of data bear huge risks for the reputation and ultimately the business of financial service providers. They need to be able to record, store, process, trace, and delete lots of user and transaction data over a long time period. Fintechs do not just need to be champions of innovation, but also champions of data governance. Often, the solution is to partner with an established regional bank, either as an investee, as a joint venture, as a franchise, or in a partnership setting. Some important regulations in different regions we are going to look at now. We're going to look at right now.
The first one is obvious: obtaining a bank license in the countries in which the fintech operates. Now, this obviously comes with capital and reserve requirements. In the US, you have the Federal Deposit Insurance Act, and in the EU, you have the Capital Requirements Regulation. This basically means that where traditional startup companies in other sectors can be short of cash and so bootstrap and manage to move on, fintechs can't do this because of the very high fixed costs and thus the very high barriers to entry. Not beyond just requiring uh, a very high level of cash to obtain these bank licenses, they also need to hand in very comprehensive annual and quarterly financial reports on a very detailed level, meaning that the fixed costs for fintechs are much higher than for other startups.
The next regulatory area derives from the fact that banks indeed do have an important function in society. In the US, the Bank Secrecy Act aims to prevent anti-money laundering. It requires financial providers, and I quote, to keep records of cash purchases of negotiable instruments, file reports if the daily aggregate exceeds $10,000, and report suspicious activity that may signify money laundering, tax evasion, or other criminal activities. So remember here that banks are also partially responsible for criminal activities that happen over their payment networks or happen over their infrastructure.
And lastly, we have the European Payment Services Directive, PSD2, and the GDPR in the EU. Compare that with the US, where there is not one single principal data protection legislation. Instead, there is a jumble of hundreds of directives enacted on both the federal and state level that have to be administered by the Federal Trade Commission. And this makes it especially hard to enter the US market as a foreign fintech.
The most effective technique to prevent anti-money laundering and criminal activities is to know your customer. And the KYC requirements they need to adhere to, or the fintechs need to adhere to, are high. And anti-money laundering targets to prevent the generation of income through illegal activities by identifying the participating parties of transactions and the purpose of these transactions and stopping the money flow if anything appears suspicious. This is especially challenging given the value proposition of fintechs. Even more so, given that they want to provide fast and convenient ways to authenticate, manage, and transact assets to the user. KYC already blocks off many users during the application process, with around 40% of consumers reporting they have already abandoned bank applications due to the lengthy and information sucking process. However, video KYC and electronic IDs have improved the KYC experience for consumers, bringing down cost of KYC for one user by up to 10x. Banks have the advantage over fintechs in the sense that they have long-term experience and standardized processes, as well as pre-trained staff, which supports them in ensuring that they meet the strict compliance standards, as well as being able to react fast to changes of these standards and the emergence of new standards. Consequences of failure to enforce AML results in hefty fines, suspension, or even revocation of license, and definitely also harm to brand reputation.
Also, banks often view fintechs as too risky businesses and stay away from them. Given their disruptive nature, banks are also sometimes reluctant to engaging in collaborations with fintechs as they fear losing market share and businesses to the fintech industry. And as trust and reputation is very hard to build and scale as a newcomer, but because these are very important in the financial services industry, there are very high entry barriers for some fintech areas, such as private banking. So in general, building a fintech is a very costly process due to the needed upfront investments in IT infrastructure, cybersecurity, legal and regulatory requirements, compliance, and also sales and marketing.
Because these build-up costs are so high, because you have a high amount of upfront fixed costs, a fintech business, at least if it is active in the B2C space, in most cases only can become profitable when it is able to attract and keep a large number of users. So it has to additionally spend a lot of resources on customer acquisition, including the handicap of KYC, where you lose a lot of your customers along the sales funnel. In the B2B space, the sales cycle is up to 24 to 36 months long to reach a steady state of recurring revenue. So you need a lot of upfront capital just to survive that initial period.
Another important barrier is the highly fragmented regulation space globally, which makes it very hard for any fintech to scale up on a global level. In the US, for instance, an incoming foreign fintech needs to be regulated in all 50 states in order to operate across the country, which is a very expensive and time-consuming process.
So based on all these challenges, I hope you really appreciate that financial services are becoming cheaper and more convenient, because it is quite a hard job to do. And we definitely do appreciate that. And that's why, once again, as in any episode, we have presented the Utopian Day in the life. We're powered by Fintech. So it's, as always, my day starts in the morning. What a surprise. I'm checking my ETFs and staked crypto assets. I've earned money overnight through those assets. I'm updating my risk preferences through a chatbot. I do not even touch my account and investment settings. My robo-advisor does that. It automatically updates these things based on my preferences and available market data.
And to mention, active management is a thing of the past. We all participate in the growth of the market and earn a risk premium for investing in innovative companies. It's also worth mentioning that algorithms have fully taken over trading and portfolio allocation. And if anyone earns alpha, the algorithms are quick to detect the information advantage and close the gap instantly.
So I enter my car and I get a really nice notification, which is that my car insurance premium has once again declined as a result of my conservative driving behavior. The spending bucket for insurance is automatically updated in my personal finance app. Great.
Now, as it's already time for lunch, I have some time to check my upcoming token sale on a digital exchange that connects social media content creators with interested audience. And this token sale allows users to chip in a commitment to issue micropayments per hour of content watched from content creators which they personally find interesting and worth investing in. Now, there's no need to spam social media channels, as algorithms automatically connect me to my target audience and ensure that consumers are recommended new content instead of optimizing purely based on the number of clicks.
So it's the afternoon and I'm checking my personal finance plan and the recent spending behavior with my mobile app, well knowing that I'm in full control of my personal finances and I do not have to worry how much I can or cannot spend on things. I can plan the evening.
And I also just got a notification and instantly decided to help a friend by issuing an instant zero cost cross border transfer to his holiday domicile in Costa Rica. He was running out of CBDCs on his app, and the restaurant did not accept any other stable coins. So I was glad to enter and help him.
So very practical applications that fintech has in our day-to-day lives. This might not be as utopian as previous episodes, but definitely very convenient and also something that soon can become reality. If you are interested in the applications of digital technologies to public finance, we urge you to check out our previous episode on central bank digital currencies, where we talked about stablecoins, the Libra project by Facebook, and how central banks are moving forward in implementing digital state-backed currency.
Also, if you enjoyed this episode, please leave a like and subscribe for weekly podcast episodes on Utopian technology presented by the two Techniax. You can also find UTX on YouTube, Spotify, Apple Podcasts, Google Podcasts, Stitcher, and now even as blog posts on Medium. You'll find the links in the description below. As always, stay utopian.
Your Techniax.